Hey, it's Carol and Tim.
And we have something new and exciting for you.
Everything you love about Bloomberg Radio is now in your car.
The new Bloomberg Business app, now featuring Apple CarPlay and Android Auto.
Listen to your favorite Bloomberg radio stations anytime.
Plus every Bloomberg podcast, the latest news and more, all at the click of a button.
It's free and simple to use. Just download the Bloomberg Business app on your smartphone and connect your phone to your car.
The Bloomberg Business app, now with Apple CarPlay and Android Auto features. Download it free in the Apple App Store or on Google Play.
Presented by our sponsor, Interactive Brokers.
This is Bloomberg Businessweek. Insight from the reporters and editors who bring you America's most trusted business magazine, plus global business, finance, and tech news. The Bloomberg Businessweek podcast with Carol Messer and Tim Stenevec from Bloomberg Radio.
All right, folks, speaking of headlines, it's been fast and furious over the last almost 5 days, and we finally have an answer to will he or won't he? And we are talking about Sam Altman because he is returning to lead OpenAI. If you're keeping track, it's been fewer than 5 days after he was pushed out of one of the world's most valuable startups, setting off a shock back and forth drama that transfixed Silicon Valley. And I got to be honest, all of us, and certainly the global AI industry, just kind of watching the play-by-play here.
Okay, not everything is exactly the same as last Friday before Altman was fired. There are some governance changes. There's going to be an initial board. It's going to be led by Brett Taylor, the former co-CEO of Salesforce. Larry Summers is going to be a director there. He's former U.S. Treasury Secretary. Also, we should note a paid contributor to Bloomberg TV. And existing member Adam D'Angelo, the co-founder and CEO of the question and answer site Quora.
All right, so let's get two guys who've been all over the story over the last 120 hours. Tom Giles back with us, executive editor at Bloomberg Technology. He has been nonstop, name on no fewer than 38 stories and headlines in the last 5 days, although I'm guessing there could be even more, a lot more. He's on Zoom in San Francisco. Mandeep Singh is here in our Bloomberg Interactive Broker studio. He's senior tech industry analyst for Bloomberg Intelligence. He too has authored a handful of reports in the last few days about the implications of this drama. So you guys are in the thick of it. Hey, Tom, let me start with you. Was this the best outcome?
Well, if you're Microsoft, certainly they are a winner in this equation. This is the company that is the biggest shareholder in OpenAI, and they were also poised to hire Sam Altman. When he initially was fired and then not rehired, and they hired someone else, Emmett Shear, Microsoft said, "All right, well, we'll take him." And suddenly about 700 of their 770 employees said, well, we're going to leave too. So Microsoft comes away as a real big winner here. I'd say Sam Altman and his inner circle also are going to be big winners here insofar as they come back to OpenAI and they're going to push for a real reimagining, an accelerated reimagining of what this company is, what it stands for, and how quickly it pushes toward commercialization and profitability and running itself like a business. This is a company that started as a nonprofit tasked with the exploration, the scientific exploration of artificial intelligence. And it certainly is still doing that. But what you've seen Sam do over the years is push it further and further into the direction of being a business, a thriving business that's growing, attracting investors, bringing in, creating products and lining up customers. And those things sometimes are at loggerheads with something that's more of a scientific, philosophical approach to the exploration of artificial intelligence. And that thing really came to a head with his firing on Friday. So now he comes back, and I think there's going to be an accelerated reimagining of what this company is.
Fascinating. So, Mandeep, come on in. You've been writing a lot of research. Microsoft and OpenAI, do they need each other? Why or why not?
I mean, they absolutely need each other. And the last week has shown how much Microsoft is invested in AI to the point that, they were willing to take the entire staff and, have them as employees. Look, I mean, the original, if you go back, 1 year when Microsoft originally partnered with OpenAI, the idea was they wanted OpenAI to use Microsoft Azure's compute capacity. They wanted, to be that early cloud player that positioned itself well in generative AI. And they did that. It worked. Then they standardized everything, their co-pilots, their search around OpenAI. When you look at the competitors, Amazon and Google, the two competitors in cloud, their growth has slowed down in cloud this year because they didn't have that generative AI, OpenAI aspect of it. And I think it's interesting given how much, Microsoft benefited. This thing happening so suddenly really caught them off guard, and they've probably helped steady the ship, but I still think there's a lot more to come in terms of transparency, why it happened, were there any safety issues that the other board members felt. Obviously, the employees didn't believe in the earlier board, so the board had to change. But I still think there's more answers that will come out in due course of time.
I agree.
And I think that reporting is going to continue to trickle out. So no sleep for either of you guys over the Thanksgiving holiday, although that's not what I wish for you. Hey, Tom, come on back in here. Carol asked you about the winners here. What about the losers here? Are there any competing companies who could have had an opportunity to kind of seize the moment, but now that Altman is back at OpenAI, they lost that opportunity?
Well, I think if you were a competing company and you were, looking on Friday afternoon, the minute he got fired, I am sure that he was being inundated with offers because people see him as a true visionary. They see him as the driving force behind the successes that OpenAI has cranked out over the last several years, but in particular in the last year, and the pace at which those are coming out. But what Mandeep said was really true. When Microsoft partnered with OpenAI in such a dramatic way to the tune of $10+ billion, that really catapulted them to the forefront ahead of people like companies like Google, which should have been, for all intents and purposes, the true leader in artificial intelligence. They had DeepMind. They had their own in-house. This DeepMind is an artificial intelligence startup that they bought in the UK, which was really at the cutting edge of this research. They had their own in-house AI effort, and they just moved too slowly on generative AI. And so when you saw Microsoft really strengthen its partnership with OpenAI, that really lit a fire under Google, and Google remains on its back foot in all of this. And you're going to see, as Mandeep said, you're going to see Microsoft incorporate not only benefit from OpenAI because of the computing power and its use of their cloud services, but also incorporating generative AI into more and more of their products and making those products, even Bing, the search engine that none of us uses, maybe even making Bing more relevant, not to mention what they do to their business products that are the real lifeblood of Microsoft's revenue stream.
Come on in, Mandeep.
No, and that's a risk, right? So if you look at the Amazon and Google approach, they want to develop their own large language model, and all their products will be driven off of their own large language model. OpenAI is still an independent entity. Granted, Microsoft has a 49% stake.
Right.
But tomorrow, if things fall apart and, again, Sam is back running the company, so you would hope things stabilize. But that's a big risk for Microsoft not having its own large language model.
I feel like, we kidded yesterday that it was TBD, and I still feel like there's still TBD to be, kind of in this story in terms of what happens with OpenAI in the future, or whether or not somebody big comes out and is a real challenger to that company.
I don't know if there's anyone out there who's...
There is. Anthropic. I mean, these are ex-OpenAI employees who started the company.
Carol was talking about it earlier today.
Yeah, and both Google and Amazon have taken a stake in the company. So just that...
So it's amazing because they're sort of like these, I don't want to call them pawns, but they're like these avatars of the larger companies that are duking it out.
We used to call Tiger Cubs, off of Tiger Management.
Global,
yeah.
And the reason why Anthropic was started because the co-founders felt that,
exactly.
Yeah.
Guys, listen, we have to go. We're going to continue with this, no doubt about it. Get some sleep. Can't wait to see all of the research and reporting that continues to come, certainly from Tom Giles and the Bloomberg Technology team, and of course, Mandeep Singh over at Bloomberg Intelligence.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Tim, a couple stories on the Bloomberg today. One was about how clean energy funds are dirt. They basically slumped roughly 30% this year after losing almost 5% of their value in 2022 and a whopping 23% in 2021. The renewables industry has been battered by rising interest rates, which have been especially damaging for new solar projects, and disappointing earnings caused largely by those higher capital costs and then lower profit margins.
I don't get it for a few reasons.
Yeah.
We'll get into it, but we know this is the direction that things are going to go. We know that the Biden administration has unleashed a torrent of funds in the Inflation Reduction Act. So anyway, that's kind of confounding to me.
And especially in a year that's on track to be the hottest year yet. We're not quite at the end of the year, but pretty much pointing there. So let's get to it with Rich Lesser, see what he has to say about all of this. He's global chair at Boston Consulting Group, headed to the upcoming Global Climate Conference, COP28 in Dubai. Rich is on Zoom in Boston. Rich, nice to have you here with Tim and myself. It's been hard to be anything ESG. Tell us, though, specifically about companies and what they are doing when it comes to sustainability and climate change goals.
So it's a pleasure to be with you, Carol and Tim. Look, I think corporate efforts on climate and sustainability continue to move forward. We see commitments to science-based targets growing. We see investments in many places growing. Many of the leaders in this space have continued their agendas. But as your intro pointed out, it is a more challenging time, particularly in the US, because of the various uncertainties, the economics and particularly interest rates and the recent bout of inflation, which is coming down, but still left capital more expensive, the political uncertainties inside the US, the regulatory uncertainties with the SEC proposal. So while it's encouraging to see the actions of a number of companies, we do not have as much broad-based action as we need from governments or from businesses at this point. Obviously, IRA is a bright spot in that, as is some of the actions in Europe and other countries. We have a long way still to go, and we're not on track for what the world needs.
So what gets us on track for what the world needs? Is it sort of a whole of government approach, cooperation across different nations?
Well, that will really help. I mean, we don't know what will come out of this COP, but there's some opportunities that could be substantial in energy and heavy emitting industries and food and agriculture, in finance. So there are a number of areas that could be encouraging areas of progress. I don't think we'll be at the end of this saying we've solved everything. We haven't been for the prior 27 COPs. We won't be at this one, but I think we could meaningfully move forward. But then there's the actions that individual countries take, whether it's around support for new technologies, finding ways, not necessarily with a carbon tax, but other ways to put a price on carbon, addressing permitting issues, which are such an inhibitor, using government procurement itself as a lever to accelerate progress. And then there's a lot of corporate actions that are possible, not just inside the four walls of the individual company, but what it does in its supply chain, how it supports its customers, how it works together with others in their sectors, whether it's on labeling transparency or finding new sources of supply for the whole sector. There are lots of ways to make progress that we're using to some degree. We need to go much further.
Rich, help me out here, though. There are companies who put out sustainability goals, missions, commitments. And then there's governments who say, you got to do this by 2020 something or whatever, or 2030 or 2040. What is it that really ultimately moves the needle? For me, it's terror. I feel like it was terrifying to see some of the headlines, or to be in New York with orange skies, or to be day after day,
worried
hot
about
day.
flooding in your basement because, every 3 years there's sort of a once in a century rainstorm.
Exactly. So
exactly.
Those things terrify me and feel like, okay, we've got to be doing something different. So what is it that ultimately moves the needle? Because I feel like commitments and goals, I don't know that you really have to ultimately abide by them.
So obviously what makes it so much easier to go faster is when doing the right thing as regards to climate and sustainability aligns closely with your own business economics to drive sustained business performance. I mean, that's the magic formula that allows everybody to invest fast. That's why things like IRA were so important, because for many types of investments, it fundamentally takes the economics from a place where it didn't make financial sense to where it does. but there's still many, many parts of the economy where IRA is a step in the right direction.
You're talking about the Inflation Reduction Act passed in 2022, where there was a lot of investing into domestic energy production and also, though, promotion of clean energy. So there was money committed to this mission.
That's exactly right. The IRA bill set aside $400 billion, but uncapped, and it will likely be much higher, both to support the broader energy transition that we need in the U.S., but also to support new technologies that would encourage us to lower the cost of those technologies, build scale, do other things. But still, in many, many cases, the economics aren't as clear as they need to be on shifting to new technology.
Why aren't they? Is it because they are still more expensive, or is it that governments need to give you...
Yeah, it's still more expensive.
Yeah.
I mean, if you're trying to make steel or aluminum or cement or fly an airplane or do a whole range of things, the technologies that would allow you to decarbonize now exist, but those technologies are often substantially more expensive than the technologies built around a basic fossil fuel economy. Mm-hmm. The good news is IRA has fundamentally changed that economic equation for some of those things. That's why you see so much investment coming into the U.S., not just from U.S. companies, but from around the world. It was a very meaningful bill, but we need to be ready to go further. And I think that if we can go further, we can accelerate progress. And I think COP is one of the opportunities on everything from food and agriculture to the leakage of methane to heavy industries that are really challenged to decarbonize, where we need agreements and we need the world to come together, that we need to make it easier. Just as a final point, a lot of the challenge will be in the global south, will be in low and middle income countries, that if it's hard for the richer part of the world to afford the capital and deal with inflation, you can imagine how hard that is in other parts of the world. And there's a lot that we can do to make the financing easier and make it more affordable to accelerate that decarbonization. And that's where a lot of carbon emissions are growing, because those countries are adding energy infrastructure to support populations.
Right. Hey, Rich, what's the relationship between the price of a barrel of oil and investments that are made in decarbonizing? Because right now we're seeing oil at $76 a barrel compared to, where things were, just May
it's come down a lot.
May of 2022, we're over $120 a barrel. So explain the relationship.
Look, it cuts both ways. The good news is, if people are confident that oil will stay at a reasonably high price, then that makes the competing low carbon technologies look even more attractive. So in many ways, when fossil fuel prices are higher and people believe they're going to stay higher, then when they run their calculations of should we invest in lower emissions technologies, those investments look smarter. On the flip side, obviously, that helps people that are in the industry, in the energy economy, in fossil fuels, make a lot of money in that space. And some of that money has been diverted into new technologies and into decarbonizing technologies, but not as, we need much more. We're underfinancing the global transformation by probably $2 trillion a year.
Hey,
so real money needs to go into that.
Just got about 25 seconds left here, Rich. So
Sure.
If the economy softens a little bit, will it make it even harder?
Sure. Uncertainty makes it harder. The more people feel confident that the economic road ahead is good, the more confident they are to invest in their future. And decarbonizing the world is probably the most important investment we need to make.
All right, going to leave it on that note. Hey, Rich, thank you so much. Happy Thanksgiving. Rich Lesser, he's Global Chair at Boston Consulting Group. And as we mentioned earlier, headed to the upcoming Global Climate Conference, COP28 in Dubai. And he certainly made some references to some of what's going to be going on there.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern on Bloomberg Radio, the Bloomberg Business app, and YouTube. You can also listen live on Amazon Alexa from our flagship New York station. Just say, Alexa, play Bloomberg 1130.
Well, around 1,000 nurses at hospitals in Wichita, Kansas are planning a one-day strike in December over staffing issues and what they claim are unsafe conditions. Another more than 500 nurses just outside of Chicago went on strike over what they say were unfair labor practices. And then, Carol, A 5-day strike of more than 1,300 nurses in Washington ended over the weekend. They were looking for more staffing, higher pay, and better patient safety.
Sounds like they want different conditions, better conditions. These strikes are all on top of the largest ever healthcare work stoppage that was happening in October, when more than 75,000 Kaiser Permanente workers went on a 3-day strike, accusing management of refusing to bargain in good faith over the short staffing issue. Well, needless to say, healthcare workers across the country, really around the world, to be fair, are feeling under pressure when it comes to burnout, a shortage of resources, pay, and more. So, Tim, you got to ask, what's the solution? Because we need healthcare workers.
Well, there are a lot of people working to find a solution right now. Aloha McBride is EY Global Health Leader for EY. The company recently came out with a study based on more than 100 interviews with healthcare executives and clinicians in 11 countries. And what they're trying to do is get to a better model. Aloha joins us right now on Zoom from Lansdowne, Virginia. Aloha, good to have you with us this afternoon. How would you characterize the state of the healthcare worker, not just in the U.S., but around the world?
Thank you so much for having me on the program. Listen, I can tell you, we saw these results across 11 countries, and what you were just talking about is exactly what we saw. This feeling of no control, a lack of autonomy, being burdened with administration, and really feeling a moral injury around real concerns for their patients' safety is really prevalent across the globe. I mean, we're talking in every single country. We saw those themes loud and clear.
So is it something in particular coming off the pandemic? Were the trends already starting heading into the pandemic? Give us some clarity on that.
We've known for a while that we were going to be seeing some workforce shortages in the healthcare arena, starting way back in probably 2018. We were beginning to project this. We were seeing some data that was alluding to this. Now, what happened during the pandemic was obviously we had large areas of the entire workforce actually leave the healthcare profession, some because of retirement, some because of this administrative burden, some because of illness, and that drove that shortage down. That combined with the fact that we are seeing an environment in healthcare now wherein the younger generation of nurses and doctors don't want to put up with the way things have been for the last 50 years, frankly.
What does that mean? Wait, let me stop you there. Aloha, what does that mean?
Yeah. Well, so when you think about what we all know about medical school and residency, we know that there's long hours and people work long shifts. However, this generation that's coming, maybe the last 2 generations, they've been taught work-life balance, right? They've been pounded into their head this concept of you can have it all. You can work hard and play hard and have a balanced lifestyle. But when they arrive into healthcare, they see something different. It's not quite what they expect. And now we're seeing some of that come to the forefront. And we're seeing demands from healthcare workers wanting a more balanced lifestyle, wanting more career progression, wanting the ability to spend more time with their patients.
So essentially bring on generative AI, artificial intelligence, and robots, because we're all, as we get older, are going to need these folks or these robots or something to help take care of us, because I've heard this too. It's interesting to hear you say that. I was talking to a recent doctor of mine, who's probably around my age, and just said, this younger generation, and we both were like, we hate to make these blanket statements, but they don't want to work as hard.
But I think a big part of what this is, and I talk to teachers and doctors who say the same thing to me, is they see what happened to people during the pandemic who now work remotely.
Yeah.
They get to eat breakfast at home with their kids. They get to go pick their kids up from school because they work remotely 3 or 4 days a week. And that's not something you can do as a doctor or a nurse, Aloha. Right. I mean, I hear that complaint from teachers as well. Teachers used to tell me, they have the best schedule ever because they get 3 months off in the summer. But now they're like, what the heck am I doing coming to school and being in the classroom 5 days a week when the parents of the kids that I'm teaching are only going into work 2 days a week?
Right. And what I'll tell you is the health systems are responding. They're thinking about new roles. They're offering different programs for nurses and doctors, different career paths. They're looking at ways to which they could offer more virtual time. And I think that'll make a big difference. I also think, to your point, around AI and automation. I was reading something the other day from Mayo Clinic, and they estimated 30% of healthcare of the administrative tasks could be automated. What are we doing? Let's go.
Well, okay,
right?
so here's a question that I have for you. As I was doing research for our interview, I came across a Bloomberg story from October that showed that the average employer-sponsored healthcare, the employer-sponsored health insurance premium for U.S. families rose 7% to almost $24,000 this year. That's according to an annual KFF survey of more than 2,000 companies. That compares to a 1% increase last year. We're paying more for healthcare. The employers are paying more for healthcare. Where in the value chain is that money going if everybody is burned out?
Yeah, well, certainly labor costs have been rising, right? We've seen the statistics, and they're estimated to continue to rise over the course of next year within the healthcare industry. And during, different segments of the pandemic, we had a lot of traveling nurses onboarded into different health systems, and those wages were rising tremendously as well.
So is it all labor costs?
I will say a lot of it is labor cost for sure. Certainly the cost of healthcare supplies is certainly adding to this burden as well. So the cost of goods, if you will, pharmaceuticals, as well as medical disposables. I think we see this across the economy, right? It's not just in healthcare. Inflation has driven up the price of many things, many sectors, and healthcare is always going to get hit with these kinds of things.
You talked about, technology maybe helping with the administrative side. That's great. I feel like it should be a given. It should be done already. But I want a clinician, who can maybe work side by side with technology to make sure I get the best care. So I am a little worried about the pipeline when it comes to actual individuals that are needed. Any thoughts on that? We've just got about 25 seconds left.
Yeah, listen, I think it's a great point. We want to see, starting in medical schools and nursing schools, individuals getting trained on what to understand about AI and digital health and technology. We want to see those digital health and technology companies and healthcare provider organizations include those clinicians in the development of all of these new technologies to ensure they're fit for purpose for these clinicians who have to use them and work with them.
Well, thanks so much for your time. Happy Thanksgiving. Aloha McBride, EY Global Health Leader, joining us on Zoom from Virginia. This is Bloomberg.
You're listening to the Bloomberg Businessweek podcast. Catch us live weekday afternoons from 3 to 6 Eastern. Listen on Bloomberg.com, the iHeartRadio app, and the Bloomberg Business app. Or watch us live on YouTube.
Everybody's got a hungry heart. Everybody's got a hungry heart. Lay down your money.
Everybody's pretty hungry for Thanksgiving.
Is everyone's...
But is everybody going to really be that hungry?
Are they going to be as hungry as they were before Ozempic?
Maybe not. So winding down on this Thanksgiving Eve, our magazine team has a great story for you. You can find it online at Bloomberg.com/Businessweek and, of course, on the Bloomberg terminal. It's a story that as soon as we saw it, we're like, we want to talk about this. It adds some irony to a holiday known for high levels of food consumption. Americans are eating less these days, actually a lot less.
Prescriptions for a series of drugs known as GLP-1 agonists. We're talking about Ozempic, Wegovy, and the like. They quadrupled from 2020 to 2022, and it looks like there's plenty more growth ahead for these pharmaceuticals in the U.S. as drug makers search for even more clinical uses. Bloomberg News consumer reporter Deena Shanker joins us on Zoom from New York. She wrote all about it in the context of the Thanksgiving holiday. Deena, good to have you with us this afternoon. Before we talk about what these drugs are doing and the way you're thinking about it for Thanksgiving, talk to me about just how many prescriptions now are being written for Ozempic, Wegovy, and the like.
I mean, millions of Americans now are taking these drugs. They are up 300%. Currently at 1.8 million together for 1.8 million for Ozempic and 453,000 for Wegovy. So that's 2.2 million total. And they are just getting really, really popular for a lot of people.
It's like off the charts. It's pretty wild. I've seen it firsthand with people who are using it or taking it, and it really does reduce their appetite in a big, big way. They're just not hungry. So I think about the impact of that this Thanksgiving, and that's what you write about. Talk to us about some of the specific people you talk to.
So I spoke to 4 different people that are currently taking the drugs, and everyone was really happy with the changes in their life, and especially what it meant for Thanksgiving. One woman I spoke to talked about not just for herself, but also her children, 17 and 21 years old, who have been taking these drugs, and they have just seen not just great weight loss results, which I know everybody wants when they're taking them, but they're also just looking at their food differently. Her kids are open to eating things that they weren't eating before. She was so excited about how now she gets to add more fruits and vegetables to the table. And, she's hosting, so she's actually going to make, the casseroles, the green bean casserole, the sweet potato casserole, the macaroni and cheese. But she was like, I'll take a bite and then I'll send those leftovers home with my parents. She's going to hold on to the turkey because she still wants the protein. But everyone I spoke to is thinking about the holiday differently. Another woman I spoke with, she was so funny. She was talking about how she has 3 sons and how they complain about the lack of snacks in the house because she doesn't make impulse purchases anymore.
Right.
And her snack drawer is really weak these days. So the kids have to put it on the list. And for Thanksgiving, she said she used to spend weeks in advance, looking for the best recipes as she got her menu ready. But one of the things that these drugs do is they turn off the food noise, as it's called. So you're just not thinking about the food all the time. So she's like, she's still going to make everything. And she's actually even skipping her shot so that she can enjoy herself a bit more on the holiday. But she's just not thinking about food all the time.
That's so interesting. Wait. I just want to cut you off here, Deena. Skipping her shot, what do you mean by that? Because these are monthly injections, right?
Weekly, I believe.
Weekly,
she
okay.
said she's skipping this week.
So she's skipping this week. So that means
she's hungry.
Is that? I mean, I know you're not a doctor. We're not doctors here, but is that how the shot works? Is it like?
I mean, she thinks it's going to work for her that way. I don't know that doctors would advise people to do this, but one of the interesting things about these shots and about these drugs is that they were initially actually, not for weight loss. They were for diabetes. And so a lot of the uses of them are off label. So because they're being used as a weight loss drug instead of as a diabetes drug. So I think what we're seeing both with the people using them and at the clinical level is a lot of, they're still studying it. They're still trying to find out all the different things that these drugs can do. So for some people, they have just been incredible weight loss miracle drugs, as they describe them. But I should add that one of the health professionals I spoke with, a pharmacist, was really quick to make sure that we didn't discount the work that the patients are doing, that it's not just like you take your injection and you're done and you never think about food again and the pounds start melting off. She was saying how it's really important that people are learning how to manage their serving sizes. They're going for, that walk after dinner. They're sticking it out through, sometimes people experience really bad side effects like nausea. And they are really taking advantage of the benefits of the drug, but they're not completely relying on the drug. Even if you think,
I will say from people who are on it, heard things like, I just have a more awareness, especially, first of all, it does cut your appetite. And so you have an awareness of kind of what you're eating or what you're not eating. And it just kind of changes your perspective with, like, when you put food on your plate, you kind of look at it and like, I don't need that much.
I guess what I don't understand, like, how does it motivate you to then go for a walk after dinner? Or Deena, maybe it's because they are so cognizant of this weekly
or they
shot.
feel better because they've lost weight and they can actually move around a little bit more.
Or maybe the expense. These are expensive too.
And the drug itself doesn't motivate you to go for that walk.
I'm driving in my car. I turn on the radio.
How about you let me drive?
Oh, no.
Who's gonna drive you home?
Honey, please, I'll do the driving.
Drive on.
Excuse me, I want to drive.
It's the question that drives us.
This is the Drive to the Close
That funky music will drive us till the dawn.
On Bloomberg Radio.
All right, everybody, just about 18 minutes left in today's trading session, getting ready to wrap up the day just before Thanksgiving. Then markets are shut. And then, of course, we'll reopen for a holiday-shortened or post-holiday-shortened trading day on Friday.
You're going to be here on Friday.
I am. I'm going to be with Paul Sweeney from 10 a.m. Wall Street time to about 2 p.m. Wall Street time. So we'll wrap up the markets and, chat a bunch.
Thanks for holding down the fort.
You are welcome.
I'll be listening.
No, you won't.
Yeah, we'll be there in Cincinnati listening.
All right, looking forward to it. So let's get to it. And our drive to the close guest, Vance Howard, back with us, CEO and portfolio manager at the fee-only registered investment advisor, Howard Capital Management, roughly $5 billion in assets under management. He's also, by the way, owner-operator with his family of the Bar C Ranch in Madisonville, Texas. I just like that little fun fact about him. Vance, good to have you back with us. How are you?
Carol, it's always good to talk to you.
Well, it's great to have you here. You're there in, I think, Georgia today. Is that correct?
No, I'm in Texas today.
Oh, you are. You are in Texas. Okay, forgive me. So what's easier to do right now, run a ranch or invest in the market?
Well, they're both. Managing money is a lot more profitable than running a ranch. I can tell you that.
Well, you got to tell us a little more about this, okay? What before we get to your thoughts on the market? What is the Bar C Ranch?
Actually, we run exotics. We run zebras, kangaroos, Gimbox oryx. We run about 6 different exotic type of breeds out there, and then we, raise them and sell them. And we have quite a bit of wildebeest too. They're quite interesting and fun to raise.
Who buys zebras?
Oh, well, you'd be amazed, and a lot of people like them as animals to look at, and then they put them out on their ranch or their farm, and they're fun to view.
Okay. I bet they are. I bet they are.
We should do a remote from there, Carol, like a little kind of petting zoo type thing.
I would love. All right, so let's talk about this investment environment. Your HCM Income Plus Fund up about 16% year to date, beating most of its peers. Your flagship Tactical Growth Fund up 23% year to date. According to Bloomberg data, that puts it in the 55th percentile against its peers. What's been a good investment this year? What hasn't for you?
Well, it got really sloppy from, around July, and then the market picked back up when the Fed came out and was a little bit more, dovish, I guess, is what you could say, or we had some good data that came out on the inflation front, and the market shot straight back up. But it's been, a pretty challenging market to trade in. But again, Magnificent Seven's been the place to be. But we're starting to see the market, Carol, broaden out, like with the small cap and the Russell 2000 started to broaden out over the past couple of weeks, which is, I think, very optimistic going forward for the market, that we're getting more players coming in and we're starting to pick up different areas of the market, starting to move higher.
Well, it's so funny, though. We talked with our Gina Martin-Adams, who said it feels like a lot of the bad news has been factored in when you look at the corporate earnings, what they said on the calls, what they said in their releases, and that a lot of that bad news is factored in, although it could be a bit of a choppy 2024. Do you agree, or do you feel like it's going to be one-way or one-way direction market?
I think we're going to have a strong end of the year in 2023, but I think 2024, I think, is going to be a great year. I think there's a tremendous amount of cash on the sidelines. We're also looking at bonds too, Carol. We started actually picking up some 20-year treasuries about 2 weeks ago, and the bond market's starting to look healthier than it has for the last 18 to 24 months. So, net, we're bullish, and I think 2024 could be a big year.
Okay, we love talking to you because you've got the HCM byline, which you've told us about a couple of years ago. At least that's when I learned about it. Explain what it is and what the signal that it's telling you right now, or should people be buying stocks right now?
They should be. And the HCM byline is nothing more than an intermediate term trend system. So it's basically telling you where the trend's at, whether it's up or down. And of course, if it's down, you want to play very, very cautious. Move some money to cash and play it safe. The byline went positive about two and a half weeks ago after being negative for about 2.5 weeks. It actually dropped off, and we had those nasty sell-offs. But when the Fed came back, it corrected it, straight back up, and we moved back in a pretty good clip. But we're bullish going forward. The byline's really, really strong. That means the market's really broadening out.
Remind our folks who maybe didn't catch you when you've been on before what that byline is about.
Basically, it's a number of different indexes that we've averaged together, plus we have a proprietary moving average that sort of tracks those different indexes. And when the indexes start to fall, it's going to go negative, and that means that we move away from the market. We sidestep it, whether it's 20%, 30, or 40, into short-term bonds or cash. And, of course, once it's positive, we go 100% back in almost immediately. And, markets trend, and this has been a pretty sloppy market for 2023, but it's still working, and it's still working out, pretty well for us going into the last, 6 to 8 weeks of the year.
Is there does it tell you if there's another, when would it tell you to actually move cash or move into cash? Like, what would sort of the signals be that would indicate to you that, okay, we're seeing a little bit of weakness ahead?
Well, the good part about it is it's not real active. And, anything that's too active, I think, is a little bit overkill. And I think you end up, just doing a lot of exercise for nothing more than exercise. But when the trend goes negative, it's going to give us a red light. And, when the trend's negative, we start moving away. So it just closes below that trend, and there we are. And then when it closes back above, then we come, firing back in. The thing is about the markets, you can have 1,000 reasons it goes down, 1,000 reasons that it goes up, but the market's going to do what they do. But you have to trade what actually is happening. You can't really trade what you think is going to happen, because that usually very seldom plays out as well as you'd like for it to. So if the market's negative, it goes below the buy line. We take the emotion out. We start moving some money to cash and short-term bonds, and getting reset to buy equities when it turns back up.
What's the sustainability of that buy line? In other words, once it turns, or once it shows an indication in perhaps the opposite direction, does it stay that way, or can it shift very quickly again?
It can stay that way. We've seen it go positive for over 3 years. It's got a 72% win rate. So, you're looking at basically a 70-30. So at 70% of the time it's right, 30% of the time it's wrong. But the good part about it, Carol, is it never stays wrong. So if it's wrong for a couple, 3 weeks and it changes back up, you can come right back into the equities. And, you're not going to break them. I mean, if you sell Tesla and buy it back tomorrow, you're not going to break it. So you can trade them as much as you want.
So the HCM byline covers individual equities too, or just indexes?
Now, that's a quant system that we run, and we run a pretty strong quant system to try to pick out what equities and what sectors of the market are doing the best. That's one reason that we picked up the small caps, and that's one reason we picked up the TLT, the 20-year bond, is because, 2 weeks ago those went positive, which is really encouraging because they haven't been positive for quite some time.
Is it telling you to pick up NVIDIA? It's down about 2.4% following last night's earnings, which by many accounts, they surpassed expectations. So what's your take on that? You own it, I believe, in your flagship fund.
We do. We've owned it for quite a long time. We've gotten to ride it. I think we were buying it around 140 a share, and now it's up, 400 and something. Mm-hmm. And we're still riding it. I think it's a great company. I think it's going to do really, really well.
Oh, did you buy on the dip last night? Would you guys buy?
No, didn't buy on the dip. We already had plenty. We're loaded up on it, and so we're pretty full on NVIDIA. We also like AMD. We've been loading up on AMD too. But I think going into 2024 with the way these companies are positioning themselves, I think it could be quite exciting.
Where don't you want to be right now? Just got about 15 seconds.
I'm not real thrilled about international equities right now. I'd probably stay away from the international markets. I think our domestic markets are, much more interesting and much more powerful and a lot more reliable.
And it's funny, if you go back a few months, we had a lot of guests saying, international, get out of the United States. Vance Howard, have a great Thanksgiving. He's CEO and portfolio manager at Howard Capital Management, joining us on the phone in Texas. All right, you are listening and watching Bloomberg Businessweek. Carol Master, Tim Stanovic. This is Bloomberg Radio.
This is the Bloomberg Businessweek podcast, available on Apple, Spotify, and anywhere else you get your podcasts. Listen live weekday afternoons from 3 to 6 Eastern on Bloomberg.com, the iHeartRadio app, TuneIn, and the Bloomberg Business app. You can also watch us live every weekday on YouTube and always on the Bloomberg Terminal.